Hello, ladies and gentlemen. Today is June 6th, 2023. And this is another edition of MSP Talk brought to you by the MSP Initiative, live today, just online, not in person. Some general housekeeping that we get out of the way in the beginning of these sessions, because, we love to just knock out all of the important items, and then we'll get into the good stuff. So mspinitiative.com. Here you'll find this and every other session we have ever done under sessions. It'll be in podcast audio format, and then there'll also be recorded video as well. We have our Community Minds event coming up in Denver, August 14th and 15th. We have a bunch of people from around the industry that are scheduled to bring you workshop-based sessions where we're going to eliminate death by PowerPoint and actually get you past bullet points on a notepad somewhere. This is our way to give back to the community. It costs absolutely nothing to register as an MSP and join us, but you do have to get there. So we'd love to have you join us in Denver this August for a 2-day jam-packed sessions and workshops. Then we have our 1, 2, 3, 4, 5 block parties left this year. The first one is coming up in Dublin. So if you're headed to DattoCon Dublin, we are doing a party for you. So go ahead and check that out. It is on the event schedule for DattoCon Dublin. If you're headed to Taylor Business Group Big, we are doing another MSP community boat party. So even if you're not going to the events per se, same would go for Dublin. You're just in the area, you can come if you're an MSP and you register. Of course, then there's the DattoCon Miami event. This is the U.S.-facing event right next to the stadium in Miami. And then lastly is the big event in Orlando last year that we brought the All-American Rejects in for. And this year there will be a new band, but from the same era, I promise. There's also MSP Community Offers. These are companies from around the industry that just want to give people in MSP Initiative land some freebies, some incentives to work with them. So check out MSP Community Offers. And lastly, just our industry calendar. We collect a lot of information on what to and not to do, depending on times, dates, places. They're all in one place. Feel free to take advantage of our homework. And if we're missing anything, feel free to submit something that should be in the calendar, but we missed or we didn't know about. And that is everything you will find on mspinitiative.com. All right. Our guest speaker today, we've brought him several times before, and we always love to hear what's happening out in the world from the view of one Reed Warren. Welcome back to the show. How are you doing today, Reed?
Hey, doing really well and excited to see you guys. I mean, I get, I'm not an MSP, but I get to tag along on most of your parties because I'm at most of those events. So you guys crushed it last time at the Big. Looking forward to seeing that again. IT Nation, All-American Rejects, great concert, a lot of fun. Just great being there. Might have smoked a cigar too. But it's so fun. You guys do such a phenomenal job and pulling off the events. It's great to be part of the MSP community.
Appreciate that, Reed. And if I wasn't bald for all the stuff that we did, maybe I'd no, it's all good. The bald was just a benefit of not being able to pull anything out, I think.
That's right.
So for the people that are live, I know, I'll be able to let you tag in if you have any questions. Otherwise, obviously, everybody can watch this after the fact. All right, Reed, it is mid-year. It is 2023. Hopefully, the pandemic's kind of in our rearview mirror at this point. Even the official government money is all dried up, no longer. Here we are. What was going to come out of that has happened, I think. Good or bad, right? Companies closing, companies starting, companies merging, companies selling. Still a little bit, especially, people who are invested, whatever type of investor, PE, VC, private, doesn't matter. We're still hearing people kind of gurgling about, the end of this year, right? In 2023 and whether they're going to take the initiative to pull the gas pedal up a little bit and hedge their bets. And there's still this thing happening in Europe with this Ukraine war and energy prices and blah, 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 blah. So we're smack dab in the middle of the cookie, the cookie jar, if you would. So first thing I want to do is just get, every time I talk to you, I'm like, hey, what do you think's going to happen? Well, like we're a little closer towards that point. So what's actually happening, Reed? I mean, percentages since we last talked to you of interest rates continue to go up. Inflation hasn't stopped. I'm sure at some point that affects everybody, no matter what the industry. What is it trending or leaning positive, negative? Is it a net zero change from the last time we talked? What do you feel?
Yeah, a good question. So as much as, I mean, at the beginning of the year, everybody was really concerned about the recession. Most of those fears have really kind of, I would say, there's still plenty of people concerned about it. I would continue to say the MSP market continues to be strong. And as much as there are those concerns, I think from an industry perspective, the MSP community is going to do just fine through it. And I think a lot of that stuff, candidly, is distraction. So companies that I would just say are focused on really doing the fundamentals of business, as far as putting money to the bottom line, really working at dialing in the growth engine, candidly are going to do well through it. I'm just going to say, just as we've watched MSPs, the reality is this: if you build out your marketing and your sales, and you really get your go-to-market strategy running, and you're doing 20% growth, hey, as long as the market doesn't take more than a 20% dip, you're still going to grow through any sort of dip. And we saw companies, plenty of MSPs grow through COVID. They did extremely well through that. That didn't stop end customers from going out of business. That didn't stop end customers from being bought and sold. And I would just say, across almost all industries right now, we're just seeing massive consolidation, right? And so I know the MSP industry is under consolidation. Private equity continues to be strong, buying up anything they can to do that. But it's not just a MSP phenomena or MSP industry phenomena. It's happening across that. We see veterinary clinics, we see hospitals, we see outpatient, we see hotels, we see just there's consolidation happening on every level. And in the end, I think as an MSP community, you need to, as MSP owners, need to be able to understand that and figure out how to navigate through it. Recession or no recession, it's either going to accelerate that or slow that up. But in the end, you still got to solve the same problem. So as you go through it, I don't think the MSP community on a broad level is going to significantly struggle through it. I think the private equity community understands that, and that's why they're so heavily invested in acquiring MSPs, is because right now it's a better investment than the public markets. And so when you can, if you can acquire an MSP that's growing at 20%, well, your investment is growing at 20%, where the market's not growing at 20%. And so as a result, we have seen, coming back to the interest rates conversation and inflation has backed off a bit. It's still above average, but it's not where it was necessarily earlier. Interest rates, continue to crawl up. But that said, as we look at the segments of the market, right? So the sub, I'm going to say the sub 5 million in revenue MSP that's doing acquisitions, predominantly doing that through debt financing. Yes, the interest rate has impacted that market because I can't borrow as much, and as a result, it costs me more to borrow, what's there. So we have seen that slow. But if you're over basically $1 million in EBITDA, the private equity space has not changed its strategy in any material ways. They've gotten more rigorous in their due diligence. But every private equity company, and talked to this morning, who was interested in some of the companies that we're representing, they're still just as aggressive in trying to acquire companies. And so multiples of on EBITDA, multiples on revenue, I don't want to get into that conversation right now, but continue to be strong in that over 1 million in EBITDA MSP. And I would just say the other thing that we're seeing a lot of this year is mergers. And what I mean by that is 2 or 3 companies coming together to try to either become a platform or become a bolt-on to a platform because they're not able to hit their personal wealth targets on their current organic growth strategy. And doing a merger is really the fastest way to be able to build equity value or improve the value of your equity in a pretty short order. We see typically 25 to 35% increase in equity value by doing a merger. So normally we would do 2 to 4 of them a year. Right now, we've already done 2, and we've got 6 in the works. And it's just becoming an increasingly hot topic. So.
Okay, noted. I mean, at the end of the day, the first thing before we get too far down the rabbit hole is like, people who started MSPs way back when, or even maybe not too long ago, right? Still need to understand how their companies ultimately are valued. The last thing I want to hear, and it happens probably more often than we all want to admit, is that like somebody's working for 20 or 30 years, and then they go and like, no, I think it's time to finally, move on and sell this thing just like I would a house or a car or a boat. And then they find out, oh, well, yeah, sorry, there's really not any value here. There's zero value.
Yeah, I mean, I'm going to put it, so just in the context, put it in the sports context, right? Life to a large extent is a race. And in not that in life there's winners and losers, but in a race or with any sporting competition, there's obviously winners and losers. And too often times, people don't think about it as a competitive race, but in the end, top dollars given to those companies that have built a good organization, bottom dollars given to those who haven't. And so in the end, as you look at it, you're going to be, when you looked at, because you can't take the business with you. Hate to break that news to anybody. You're either selling it to employees. That doesn't usually work really well, although it can. You can sell it to your kids, but I know a lot of MSP owners whose kids don't want their business. Otherwise, you're selling it to somebody else, and in the end, it's going to come down to the eye of the beholder. And similar to owning a home, you can either invest in it and build equity value in it, or you can kind of let it decay. And too often times, people don't keep up with the maintenance, don't keep up with the curb appeal. And then at the final stages are trying to pull it together really quickly to polish it off. And I would just say it takes time. One of the things that it's a change for us, and I'll be sure to post it up on the website as we get it built. But one of the things that we've really changed, we see this happen so much from the sell side, where sellers come to us and says, yeah, I'm really kind of tired. I really, I need to sell my business. And you work through it, and they're leaving 40, 50% of their potential value on the table just because they've hit a fatigue point. And that's oftentimes millions of dollars. And we have a client as an example that we recommended making some changes to. They could, if they made all the changes, and it would probably take them 8 to 10 months to do it pretty aggressively, could possibly sell for $4 million. They decided not to make those changes, and we're hoping to get 2.5. And I'm like, hey, you're leaving $1.5 million on the table because you're too tired. And that's just it's a reality that we see quite a bit. And so one of the things so we want to be able to change that. We really want to be able to help. I mean, I own a company, and I know the fatigue, and I know the work that goes into it. But we're going to be rolling out Valuations as a service. It's going to be doing an annual valuation with quarterly updates, so we can track your value creation quarter on quarter, year on year, and then with that start to layer in recommendations for how to transform the value of your business. So most people are using EOS or something like that, and so just recommendations on what to do with that. But part of that whole piece is, as we build that out, we can now map towards those personal wealth targets that you have. We can weigh that tax impact and say, hey, you're going to hit that number that you're looking for, I don't know, Q4 of 2024. As a result, these are the things you need to be working on today to be able to maximize that event in 2024 when you get there, rather than hitting 2024 and go, oh my gosh, it's here. Now what do I do? And at that point, it's kind of too late. And so really wanting to be able to help MSPs who have run the race long and run the race hard and spent 20, 30 years, be able to really harvest and maximize the value of their business at that point. And it just, a lot of that is just born out of the fact that we end up most people coming and saying, hey, I'm ready to sell, are just leaving way too much money on the table. But they're kind of out of time and out of energy at that point to really make that happen. And I would just say for most MSPs selling, it's usually a 2 to 3 year journey to get all the ducks in a row, to get it done nicely, and to really be positioned. And regardless of whether you've got 2 years or 10 years, our argument pretty strongly would be go through that process and then live ready, because the best opportunities come usually when you're not looking for it. And so if you're ready to be able to take that opportunity when it comes, you're much better positioned to be able to do that.
Yeah, no, that's really good advice. I mean, ultimately the valuation as a service is intriguing, because usually when somebody goes to go through a project of getting an evaluation for themselves, sometimes people just go out to get a valid offer so that they can say, hey, here's what somebody's valued my business at already, right? And then like they have really no intention of moving forward. It was to use it for something else. It could be, hey, now that I have a valuation for my business, maybe I'm going out for traditional funding, and like I can prove what I'm, what the foundation that I'm borrowing against is, or hey, maybe maybe there's something I'm doing with my personal finances, and I need to be able to actually have a number, dollar figure associated with whatever my business is. Hopefully in a good way, sometimes in a bad way, like getting a divorce and then two sides are arguing the value of the business, right? Whatever.
But to that point, George, super good thing, right? And so people think of valuation in the context of some sort of exit. The reality is, if you're aggressive in the marketplace and you want to do acquisitions similar to a house, you can only borrow so much against your house, right? The higher your home is appraised for, the more you can borrow. Well, the same thing's true in your business, right? So if you, coming back to the company we were just talking about, hey, if you're valued at $2.5 million, well, you can only borrow up to about 70% of that equity, right? Well, now you're talking less than $2 million that you can borrow against, right? If I buy the business at $4 million, hey, I can get $3 million of lending as an example to go do future acquisitions. And so when you look at it, you got to look at the business as a leverageable asset for accelerating the business, but also accelerating the wealth. How do I accelerate my growth rate? Well, you can organically grow it and dial that in. And if you're growing at 20%, you're crushing it. But now you can take that 20%. And if you're optimized, hey, now I can borrow against it and I can grow another 20% through acquisition per year. And now I've got a 40% growth rate, and can really move the needles on the business and really drive up the value of the business. But a lot of that has to do with understanding what drives value and how to best leverage that value towards growth.
Yeah. I made a comment maybe a couple weeks ago now where I came to the conclusion a while ago that if you're playing the game well and you're holding your cards well and doing what you're supposed to be doing, you shouldn't be retiring in the MSP business. You should be using the MSP business to figure out what you do next.
Right.
And I know that maybe that message, comes hard to some people, but it's like, hey, listen, are you going to invest in properties? Are you going to invest in securities and in the stock market and, mutual funds? Are you going to start another company? What are you going to do? Right? What is the next step?
Right.
That you can use from this position that you're running this company now to give you the bouncing point to the next place. The problem is people don't and listen, like you said, there's EOS, there's a ton of things out there, but people need to envision, hey, what does 5 years from now look like? What does 3 years from now look like? What does 10 years from now look like? And I feel like sometimes, the ebb and flow, the trench work that comes along with being in this business. I mean, it's a hard business. I hate to say it. It is not a luxury business. It's a hard business. And quite frankly, whether you're on the front lines and you're owner led and you're underneath the desk plugging cables in, or you're managing a bunch of people who all have people problems, by the way,
right.
You're also kind of trying to balance out the fact that, hey, all of the things that make the technology business problematic are starting to become more official issues, right? That come with laws and strings and regulations and all the other stuff that comes with it. It's a tough business. So I'm not saying you can't be successful at it. I'm just saying compared to everything else you could be doing out there, This is
Right.
not one where like you shut the lights off and go to sleep at night. You're not, like it's cool.
Right.
Wake up at 9 o'clock in the morning and open the door and like it's all good. I mean, you can try it, but I guarantee you're going to get dragged out from, a 9 to 5 job here. So at the end of the day, and guess what I've been trying to say through my kind of throwing everything out of my mouth against the wall is even like you need to understand the rules of the game so that you're not jammed with them at the end.
Yeah, totally. And I know you're come on, Eagles fan. There we go. Whew.
How did you
I
forget?
blocked them from my mind because they keep smacking the Vikings and I have to remember it just for you. But it's like when you think about a good football game, it's about winning in the first quarter and the second quarter, because then when you get to the fourth quarter, you have options. You can play out the clock. You can do all sorts of things and not worry about losing the game in the fourth quarter, right? And too many, this may spark some conversations with my Minnesota fans. You don't want to be a Vikings player because, hey, we try to win the football game in the last quarter, in the last minutes of the quarter, and we're always up against timeline. And guess what? You often lose, and you usually lose, right? You want to win the game early. And coming back to that just means, hey, have a good plan. Make sure you leave plenty of options on the table. And too many people are just hoping that their business is going to be valuable enough to exit when they get there. And the reality is, if you start early enough, creating value within your business actually gives you options. It gives you the option to be able to, say, hey, I'm going to take these proceeds. I'm going to diversify my personal wealth into, real estate and other pieces, right? In the end, the optimum place to be is when I get to that place and when I need to sell my MSP, I don't actually have to get a lot from my MSP when it sells. Not that I don't want to, I want to, but my retirement, my next stage of life is not dependent upon having to hit an unbelievably high number for me to get there. And that puts a lot of strain on it. In the end, it gives you options. There are some great options from a deal structure perspective that we don't really get to talk about. You can actually do a transaction that's completely tax-free. You just have to be able to take those payments over a 10-year period. Well, that's great if you can take 10 years, right? But most people can't. Most people don't. They need the money now to be able to get to that target. So you have these options within deal structures and estate planning to be able to move the assets into an estate and be able to take terms and get reasonably good interest rates on them and be able to do it in a tax-free manner. IRS doesn't let me say that, in a tax minimized manner. And but the whole point is that option's only available to you if you've done a good job of preparing and a good job of driving other investments to the place that you don't have to have a kind of that big payday at the end of the transaction. And typically those other options actually pay out better. They just take longer to be able to see those realized. So
I'm trying to figure out which analogy is better. It's the annuity on the lottery hit, right? That like pays out over time, or it's the guy on the Mets that's still getting paid every year from like 25 years ago.
Yeah.
I mean, either way, it's tax-free sounds or tax minimized sounds really good. So like going back to your customer example, like hey, I don't have time to like make my business worth 4 million instead of 2.5, which 10 months doesn't seem like an awful lot of time. What are some of the things that needed to be done in order to get from the 2.5 to the 4? Meaning, like, was it restructuring the books? Was it changing the agreements and going back and having their customers agree to something different? Like, what were the big items that needed to be moved in that 10 months?
Yeah, and we see this really consistently across not just this one, a lot of organizations. It's typically really sloppy financials. And a lot of that just comes to the fact that, hey, I'm an MSP owner. I love the technology. I really do accounting mostly for my tax guy, who worries about just, making sure my taxes are done right at the end. And so it's not really about operational maturity and really getting to driving value in the business. It's like, hey, I just kind of throw numbers in there. And so, in their case, they tried to incubate 2 other businesses, and so all the expenses were woven in there, and basically expenses for 3 businesses were woven into one. Their profitability was really low as a result. Well, the only way to clean that out is actually to apply those to the appropriate business. For a number of reasons they couldn't, but then you're trying to go through it from a normalization perspective. Well, now you got to go literally transaction by transaction through 3 years of financials to carve out and pull those out. And so as a result, that was going to take a huge amount of time. And because they hadn't invested in, having an accountant on board to help with that journey, nobody could step into it but them. And they're going, yeah, but I'm trying to still run a $4 million MSP, and I don't have time to go spend literally a couple hundred hours of work going through the last 3 years of transactions to be able to clean it up so that I can be presentable. And so that was a big piece of it. And so, some things, about every quarter, they changed the way they tried to account for things. And so there was project work in MSP, in their MSP line of business or managed services line of business. There was product in their managed services line that wasn't, product for managed services. It was just somebody wanted a laptop. And so just in the end, they were going to have to go transaction by transaction through the last 3 years of their financials to get it organized. And that was going to be really kind of the first place. The other elements were, let me just put it this way. When you're fatigued, you don't make the most rational decisions. And so if you're operating a place where you're consistently doing 70, 80 hours a week, you actually don't have time to do it right. You just have enough time to get it done, and you're just trying to hope it doesn't bite you later. Unfortunately, with transactions, all those little details come out of the woodwork, and they do bite. And so there's not really a way to dodge that. And as a old saying, but at some point you have to pay the piper. Unfortunately, the transaction is when you have to pay the piper.
Got it. Well, I mean, so what it sounds to me is, even if it's a third party outsourced bookkeeper, still would pay to have somebody be doing things on the regular rather than waiting for 3 years to go back and do it. By the way, we're not talking about a very expensive thing, right? Could be $300, $400, $500, $600 a month, right? I mean, we're not talking about like a full-time payroll type person. And then,
and to that point, I mean, a lot of that, candidly, is most of us, and I'm no exception, right? So I'm throwing stones at myself when I say this. Hey, when you launched the company, you just went to QuickBooks, you took their sample chart of accounts, and you just started working with it. Because I did a little bit more than that, but in the end, that's what you start with. And then as you go to peer groups and you're involved in MSP Initiative, you hear people like, oh, I should do that. Well, the reality is you need to really sit down with your accountant or bookkeeper, get those chart of accounts set up really well, and then consistently track it to that. And that's where you need to have, when you come into a transaction, 3 years of really nice, clean financials. Well, you can do one of two things. You can either go back 3 years and clean it all up and redo your financial the last 3 years, or you can start today doing it right. And in 3 years, it'll all be done right. Right. And so I think to that end, so much of that is just planning ahead and then just being really consistent with it. Listen to your advisors. Actually, a good CPA, you may, cringe sometimes at paying, $50 an hour rather than $35 an hour for a good bookkeeper. Hey, it's worth the extra money. At $15 an hour across the number of hours they put in is going to do more, it's going to provide more value for you from a return on equity from a transaction that's clean. In this company's case, that's $1.5 million. Well, if they've just been paying somebody, a good bookkeeper, to do it right for the last 3 years, so what would it cost them? $10,000, $15,000, but they could have made 1.2 million. So you got to look at it, from that perspective. That as well, that just says, hey, when you look at running a business right and creating value, that equity value, the multiple that gets applied, goes up. And in the end, most of these things where people are trying to save money, they're actually hurting themselves trying to save money. They're actually diminishing the value of their business by not taking the appropriate step, because getting things lined up. And that's a conversation for another time of all those different pieces. But a lot of it's going to come down, first of all, just to profitability, right? Financial, good articulate financials and profitability. That becomes the fulcrum or the leverage that all the multiples get applied to. So growth rate and lack of customer concentration. So no customer being too large, the business not being dependent upon you, having good recurring revenue, your growth rate, all of those factors impact the multiple. But that multiple is applied to whatever the baseline is. And so if you change your baseline from 500,000 to $1 million through financial efficiency and good record keeping, hey, you more than doubled the value of your business just in doing that piece. You can't, really hard to go from a 5x multiple to a 10x multiple, but I can go from 500,000 to $1 million and double the value of my business.
Wow. It's, again, these are the things you don't think about when you're like pressing go on starting a company for the first time. Quite frankly, like probably just like, what do I go file to be a company, right? Like they're just, some people don't even see a lawyer, right? It's like, they go to legal Zoom or something, right? But I mean, bottom line is probably should learn from like people who have gone through it. In your case, you have both sides of buyers and sellers, right? So you've seen it many more times than anybody's probably gone through individually, unless they're in that business of buying, acquisitions, whatever. I thought coming into 2023 that we would see actually growth in the MSP market, right? Meaning like, I don't know, or, back in the day when Joe Panettiere over at Channel EDE, he'd say, oh, there's like 700-800 transactions a year in MSP land. And I'm like, okay, well, like, I don't know, there's 80, 100, 150,000, depending on who you talk to, companies out there that could, fit the definition. But like, obviously when internal IT gets shrunken, those people will usually jump out and start new companies, right? Because like they don't have jobs to go work with on the other side. So, everybody says that this, the Paul Dipples of the world will say this industry is very mature. So mature that we've been able to tell you exactly what's going on, why, where, how, why. But it's still growing, not shrinking. Do you agree with that?
I do. I mean, if you were at the Kaseya conference, they talked about it there. I was in their M&A pre-event. They were talking through some of those statistics and stuff like that. But the reality is this, the growth rate in the MSP market, for every company that gets consolidated, 2 to 3 companies are born in the MSP space. And so there's more MSPs coming into existence than are being consolidated out of existence or going out of business. And I think, and it's just it's a true paradigm. So I believe that the market is from a number of businesses is definitely growing. That said, I think it's a tough market to grow because everybody's using somebody today. So it's not greenfield from an opportunity perspective, but that's only going to lend itself to ongoing acquisitions and ongoing consolidation between firms, because these are, the reality is it's easier to go acquire a company than to organically grow. Now, that's not a statement that you should quit on the organic strategy. You need to have a good organic strategy. But the reality is this, for when you look at really accelerating your growth rate, that's going to be done through acquisitions. And then what's the backbone to acquisitions is having a good financial position or a good asset that you can leverage to go borrow the money to go do acquisitions. And so when you look at the value creation, it is a cornerstone to your organic growth strategy. It's a cornerstone to your eventual exit strategy. It's really your cornerstone to understanding how to best invest in your business to get to a greatest return on that investment. And you really need to, I mean, a lot of people are really passionate, and it's all, I don't want to reduce the passion of, hey, helping customers with their technology and being the best technology firm out there for your customer. But that's critical, and you need to be passionate about it. But you really need to switch gears on as a mindset as owners of MSPs that says that is mission and that provides purpose, which is great. But you need to look at your own business as an investment. Would you invest in your own business? How do I optimize the investment in my own business? And really look at it much more strategically and tactically from a business development perspective than just being, passionate about delivering on the technology side of things.
Yeah, no, it's fair. We've had Peter on from service leadership, several
Yeah.
times. And, the last one was, we talked pretty extensively about, like hiring, right? And like figuring out, what the right areas are in terms of, cost per position and how to, over time, incentivize those people and grow, and realistically grow their salaries over time, et cetera. I mean, ultimately, um, one of the over the last 20 years, at least in, from what I see, it's one of the top 5 things that comes up over and over again, which is like talent, right? Retaining talent, bringing new talent in, that kind of thing. How, when you look at companies, as part of the analysis, what the payroll is and what the salary is per position, and whether they're in line with the revenue of the company, or they're under, or they're over, does that, I'm sure that calculates somehow.
Yeah, absolutely. I mean, and Peter's done a great job with service leadership's done a great job on their salary survey. I actually subscribe to it, and they do a better job than, candidly, they do a better job than we do on that, because they have the data for it. And so we do lean on, other experts like that for the work that we do. From our perspective, as we look at it, really a lot of that's going to come down to profitability, right? So in the end, if I have market rate people in the right positions, then I'm able to drive top quartile. And that's one of the things I love about service leadership. You can leverage your salary surveys to be able to understand how your employees align to that, and then be able to say, but this is what. And I love their statistics around, top quartile firms. Top quartile firms don't have the most expensive people in it. And you just got to look at really being able to, hey, how do we drive that? But I would just say, coming back to the sports analogy, that we're talking about, it's about the value proposition. So you need great people, but in the end, people pay a premium, not because of your talent. They pay a premium because of the value proposition. If they believe that they're receiving a great value for what's being provided, they'll pay a premium. It's like, why do people buy BMWs or Mercedes over, a Pinto, or whatever vehicle you may, look at? Why? Because there's a value proposition there on performance and things that willing to pay a premium above whatever the kind of the average is. And the same thing's true in the marketplace as you look at it. And so where we engage is oftentimes, so our take on that, we take a look at the payroll, we take a look at the expenses. We're going to take a look at that and say, hey, for what you're charging, you're paying your labor expenses are out of line with what you're able to charge. You can solve that one of 2 ways: increase your rates, which is more often the case, and the easiest way to solve that than reduce your your payroll and what you're paying people. Finding an offshore model can work really well, and there's some really great options, whether it's leveraging the Philippines or South Africa. I've had a number of clients, most recently Scaled is one of the companies that does that, where they'll leverage South Africa people, and the English is phenomenal on that perspective. And then you get the King's English. I can't say the Queen's English anymore. The King's English, but have done a really good job with it. It's a great way to provide great labor arbitrage, but then also help out other communities on a more global area that wouldn't necessarily have some of those opportunities. And so I think there's a lot of ways to be able to do that. I realize not everybody can offshore because of government contracts and other things that you have going on, but even in that situation, really putting together, and Peter can certainly talk about that within service leadership, putting in an MBO or managed by objectives type program, which in the end, it's a pay for performance type program. And so you can pay for and actually afford to have top talent that is overpaid, but that's because they're producing above average value. And as a result, customers and clients are going to pay premiums to be able to have that above average value proposition or that premium value proposition.
No, that's fair. I mean, one of the things that always intrigues me, I guess, is people who try and hey, like you're in another metro, right? I want to see how I match up against you. And you see that a lot in the peer groups, by the way, right? Like these, kind of geographically dispersed people trying to like measure up against other people in other metros. There was conversation with Peter as well about, as the lines blurred now that all this remote work is occurring, in a way where, like you can't necessarily, like before it was, hey, like, New York City is its own animal compared to a different area, right? Or like, a tier 2 city compared to another city somewhere on the other side of the country, right? Like the whole, my area doesn't bear that cost if I charge a certain amount kind of thing. So like, does that still play? Meaning like on both sides of the aisle, does it still play on the salary side? And does it still play on the, what I think I can charge cost, the area will bear kind of side? And like, does that play as much as it maybe has in the past?
So certainly from a talent perspective, we're just seeing more and more, you can use hub zones, you can use a number of different places to find talent and do it pretty affordably. I would say the barrier on the sales side of it is more the MSP owner than it is the customer. The number, I can go to just about every NFL city, and you're going to find people that are like, my customers never pay that. And in that very same city, I can point to somebody who's top quartile who's charging twice what you're charging, and they are scaling and growing, and it's not an issue for their customers. That barrier is I may offend people when I say this, but it's more you and more mental than it is a real customer barrier. The reality is most MSPs don't know really how to sell, and they just know how to take orders. And when you take orders, all you can do is take the order and take the price that people are going to willing to be able to pay for it. Building a good sales engine that really is able to drive that and sell a value proposition. I've got a customer in New York, very focused, built out a great program, and they're getting $800 a user in the target market they're at. Why? Because they have a great value proposition, and nobody's complaining about $800 per user. And a lot of people are like, oh my gosh, how do you do that? Well, because they're not afraid to sell, and they're not afraid to be focused and verticalized and create a great value proposition. And so it is, kind of coming back to it. I had somebody say, well, we're kind of like in the burger business. I mean, there's not a new burger. Well, you're right. You're in a burger business, but nothing's stopping you from building what's now a Big Mac. You can only get a Big Mac in one spot, McDonald's, right? And that's 2 patties, and it's 3 pieces of bread, and it's some secret sauce. Well, the secret sauce, I hate to break it to you, it's just ketchup, mayonnaise, and some pickle relish. Maybe teens of mustard. I don't know what the ratio is, but to a large extent, I mean, it really is about looking at your business in a different way that says, hey, how do I build a Juicy Lucy? Well, I put a piece of cheese in the middle of the burger and then cook it, right? And so there's a lot of ways where you can build intellectual property. They can build a great value proposition that only you have, or only you have in your marketplace, that people are going to drive to or pay a premium for as a result of that unique blend. And so it is about thinking differently about your business and coming up with creative ways to be able to position that. Verticalization, we've talked about that before, but it's, hey, going after a specific vertical, whether it's wealth managers or attorneys or dental IT. I had a client that did well through COVID, who was focused purely on dental IT, because none of those guys actually went on business, and none of those guys could afford to have their managed services shut off. And as a result, they still paid through it, right? And so, yeah, and hey, when you need a root canal, the consumer needs a root canal. And so they're going to go somewhere to get that, right? And so I just would tell you that a lot of people are afraid of that verticalization strategy. As long as the market's large enough to be able to do it, and as long as your growth rate exceeds any sort of pullback, you're still going to be golden. You're still going to grow even in down markets.
Fair. Just to make sure from past calls, nothing's largely changed here. The percentage of reoccurring revenue, and I guess there's a split between services, like Office 365 versus labor, is categorized. But like, still, I believe from past calls, the target percentage is like 80% of your business you want on a reoccurring revenue versus 20% could be one-time revenue. Is that still accurate, or do I have the percentages wrong?
Yeah, I mean, most people are going to want to see your reoccurring revenue north of 50%. I would just say, best in class is pushing 75, 80% reoccurring revenue. But how are you getting to that? A lot of people are, I would just say, best in class, and I see this time and time again, they figured out how to take project work and turn it into a managed service. And so they build it into their per user fee, and the customer ends up going, wow, I get like free projects. Well, yeah, and I'm paying $350 a user, but I get free projects for $350 a user, right? And in the end, because you're able to do that, you're able to sign them to longer contracts, because in the end, you're absorbing the cost of the project into your fee. In the end, though, it's differentiated. Nobody can really displace that, because most people are trying to, and the end customer has kind of grown weary of the proverbial nickel and diming of projects, right? And so to do that effectively, you have to have good project management, you have to have good leadership. But the beauty of it is, now when I move a customer onto that, I don't have to do all of that project work in 2 months. I can actually spread that across the course of a year. I get better utilization rates, which in turn drives better profitability. I end up with a happier customer with longer agreements. And so when you look at value creation, again, building project work into your managed services and making it per user does so many things for you. It improves, like I said, improves profitability, improves customer satisfaction, and extends your contracts, which drives value to your business as well, because every buyer likes long managed services contracts with some teeth in it, because you're putting up the upfront cost. The end consumer has the expectation that if they leave early, then they're going to have to pay for some sort of premium, because you've done the investment for them. The beauty of that is, if you amortize that project cost over a 1-year period and you make them sign a 3-year contract, years 2 and 3 are incredibly profitable.
100%. I would love to see the practicality of the people who have been able to get projects kind of jammed into the reoccurring kind of situation, right? Like, sounds great, but like, I would love to see what the day-to-day looks like, and being able to like make sure that they're not misguessing how much project work gets put into it.
Well, and again, this is going to come back to good project management. So a lot of them are looking at, hey, what's all the lift that you need to have happen? And rather than doing it over, 2 months, we're now going to do it over 4 quarters, which now means I have to have quarterly meetings with my customer. This quarter, we're going to take on these 3 initiatives. We're going to do this lift. We're going to do these pieces. And so it comes back to good project management. But where most people go sideways is they try to do too much of that lift too fast. And they get sideways on it. And so when you take it over a longer period, you're able to get better utilization, out of your team, because in the end, I'm not paying for a team to sit on the bench, because I have these long-term relationships with my customers. And when you build that in, the customer expectation isn't that you're going to suddenly do all this work for them right at the beginning. They understand that it's going to take time to be able to do that. So you're going to work on what their priorities are, what the lift needs to be, and working through it. And again, it's managing customer expectations, having good project management.
Maybe this is more of a business maturity question, but I'm going to throw it out there. A lot of MSPs start to get into some of these regulated industries, right? That require compliances, and like some MSPs just are putting themselves through a SOC 2, for example, or, whatever. Does that help at all? I guess it depends on the buyer, but like, does that type of putting yourself through that type of, scrutiny, what does that pay on the other side?
So I'm a big fan of cybersecurity and building that in. I think it's a depreciating, is the value of it's diminishing over time, right? As more and more companies become SOC 2 compliant, there's not as great a return on it. If you were to go back a year and say, hey, we're SOC 2, hey, the market would pay a higher premium today for that than if you're that today. Partly because there's been such a good job within the major vendors of being able to outsource a lot of that compliance related pieces. Where it makes a big difference is more in the government communities, or the government subcontractors market, where you can have a lot of those values. I think in the end, though, today the market is moving to the place that there really isn't going to be space for an MSP. Everybody's going to be an MSSP. And so as that becomes more normative, the value proposition is diminished over time. And so I think the reality is, one way or the other today, whether you organically build out and become SOC 2 compliance, or you outsource those pieces so that you can become compliant. You got to do one or the other. I would say, as with most things, stay focused on what you're best at, right? If you're not good at the cybersecurity pieces, don't try to be. Just leverage the outsource agency that can come in, and a third party that can come in and be able to do that. There's a number of companies that'll do that white labeled. They can do it behind the scenes, be able to provide great support to your customer base, and then you don't suddenly have to figure out how to be there and stay on top of that cybersecurity element, which is incredibly complex and fast changing, right? So, but if you're hoping to avoid it, you got another thing coming, because in the end, you've got to either embrace it, or you're going to need to sell into somebody who already has it. And that's, we see that happening. I mean, candidly, that's one of the drivers today for a lot of MSPs is, hey, I don't know how to do that really well. And it's easier. Right now is a great time to sell, because the expectation isn't that everybody has to have a cyber component to it. But if I'm selling into a company that has a great cyber component, now I'm going to be able to get that compliance, be able to provide that to my customer base, and leverage a transaction at the same time.
Maybe this is a unique use case, but I'm going to throw it out there. What about the guys that like start an MSP, they get it to like, I don't know, it's called $1 million. That's a nice round number, right? They're like, oh, got to sell it. And then like 6 months later, start another MSP. And then they build it up again. And like effectively, they're not trying to build a mega MSP. They just get it to like the floor of where somebody's willing to buy it. And then they kind of move to the next.
So is that an issue? Is that
No,
what you're
I mean,
saying?
do you like, I guess the real question is, what's the floor? And I guess that could be variable, right? Is it 750,000 in sales, 800 million, 2 million? Like maybe what's too small? 250,000 in sales. Like at that point, it's just a job, right? Like what are you seeing?
Yeah, I would just say, so we do have a number of clients that are more that we do valuation work for, that are in that, 1.5 million in revenue, sometimes even as low as 500,000. The challenge for most of them is, it really is, I mean, the reality for most of them is it's really more of a lifestyle. You're not building a lot of wealth, right? So in the end, as we take a look at, in fact, I was on a call yesterday with a guy who runs a business about 800,000. And he produces about $60,000 of profit, and so is going to could sell for maybe $250,000. Well, he's kind of looking at it and go, well, that's basically what I take in distributions and cash. That's maybe 2 years of my income. And I'm like, yeah, that's what it is. It's not a way to get to some sort of exit. And on a firm that's small, you're not getting $700,000-800,000 in value. You're going to get, because of the risk, it's all built around you. And the challenge with that is a good buyer is going to really kind of force you on the not to compete. And so you got to move somewhere, or move to Nebraska for legal ways around non-competes. But in the end, you got to go do that. And so you're just not able to create wealth. You get a great paying job, and you get to be your own boss, and you get to make a good living. But you're not, unless you're diligent with putting away money while you're making $250,000 towards your retirement, you're really not building a wealth engine or an asset that's going to be able to really drive the value of your business. And I really felt bad for that conversation, because the seller's close to 70 years old and was hoping to get $1 million for the business. And it's like, I'm sorry, I can't make it worth that much. So for people that do that, just understand the game you're playing, right? It's great if you want to build a lifestyle. It's great if you want to have a great income and not have a boss and get to do things when you want to do it. It is, but it's not a way to build a wealth engine for a retirement event. The other thing is today's market's becoming, you really do become, one ransomware attack away from being out of business very suddenly. And it's not that you can't recover and maybe, change your name, change your label and go back out to the market again. But the risk profile in the market today is becoming increasingly difficult. And so, you got to ask yourself the question, really, for a lot of them, and this was our encouragement to this individual, is, hey, sell for the 250,000. You'll be able to move to a place that you'll be able to make a more stable income, and continue not have to run the risk of running your business, because the risks are real and they do happen. So,
Yeah, that is for sure. Very curious. I'll be keeping an eye out on valuation as a service. I think that could
it's a
be
monthly subscription.
I got that part. I think part of it's just like, hey, instead of a one-time engagement, it's like almost like anything else, right? It's like, hey, I'm working towards a goal, right? And like
Yep.
being able to see how I'm doing versus maybe how other people are doing, because I'm sure you're kind of crowdsourcing some of the data to create that service. So I think that's a great idea. I have no idea what it's going to cost, clearly. I'm sure we'll find out soon, but better to know, especially if you're like, maybe not at the beginning, I would say, but like if you're a little bit down the road, like, hey, where are you at?
Yeah, so just where we're at right now on that journey, we have a pilot program that's running. Our goal is to get the proverbial bugs worked out of it by the end of Q3. We're hoping at IT Nation to be able to kind of launch that as a major initiative going into 2024, getting it signed up. I'm going to hold off on quoting pricing at this point. My team will shoot me because they always tell me I charge too little, when like every other owner, I'm like, yeah, but I want everybody on, right? So, but more to follow on that. But here's the thing, we're coming back to the same thing. In the end, it's about the value proposition, right? If it helps you make $1 million more, yeah, it's probably worth $750 a month. I didn't say that out loud. I just thought that maybe,
We'll see. We'll see where the actual price lands. I like the idea. And quite frankly, I think that I think you'll probably have a pretty good run with it. I'm sure, as everything, it'll take time, but I think anybody who actually just wants to, start the process, it's probably a low barrier, right? Versus like going through an entire evaluation process from ground zero. Reed, really appreciate your time. Constantly learn new things every time we talk, because like, quite frankly, you're in an area where a lot of people don't look at it until they're ready, right? Or they're trying to get ready. So like, we learn from you. I assume the website's still itvaluations.com.
It is.
So you can hit Reed's website, check it out, keep an eye on it, bookmark it, wait for him to launch that service, hopefully, towards the end of the year. Obviously, somebody wants to reach out to you, they can either do it to the website, or I'm sure you're on all the channels, LinkedIn, whatever. Let me guess, Reed at itvaluations.com.
You got it. Two E, R-E-E.
I didn't even look. I just assumed. So R-E-E-D. Okay, at itvaluations.com. I am sure we're going to connect way before IT Nation at the end of the year. So stay tuned. Otherwise, this session was recorded. And by the way, all of the past sessions with Reed were recorded too. So if you want to go back and rewind and like learn, because every session comes new things, you can go back and listen a little bit and see what comes out of it. You'll find that at mspinitiative.com under sessions. We'll do these Tuesdays, Thursdays, 1:00 Eastern time, and I will catch up with you on the flip side. Reed, thank you very much.
Thanks so much, George. Have a great day.
You got it.